Friends, in this video for ITHOUGHTWEALTH, I am going to talk to you on the topic managing single stock risk. What is single stock risk? One stock becomes too big in a portfolio. Let's say you own a stock and it presently occupies 50% of your portfolio. But the reasons to create or to experience single stock risk are different. If you have bought stock in a company which did exceptionally well and that exceptional outperformance relatively did much better than the rest of your portfolio, then that stock will keep gaining weightage in your portfolio if you continue to just hold it. So when that weightage keeps going up, single stock risk slowly starts to come into your portfolio. In a bull market, many people don't care about this because that stock is single-handedly pulling your portfolio up and taking you to a better place. Nobody will want to cut that position because it's still doing great. And many of you are also told that don't sell your winners. Risk management is something which one must think about constantly, whether in good times when one stock is pulling your portfolio up or in difficult times where only one stock is performing and the rest of the portfolio is not performing as much. Portfolio stability is extremely important in all market context. There is another way in which single stock risk comes into your portfolio. You buy a stock, it comes down, you buy more, it comes down further, you buy even more, then it comes down to a level at which you like it so much. The valuations are juicy and extremely attractive. So you go overboard buying that stock. At that point, you put all the money you have into that stock because you are completely convinced in it. This can lead to a single stock becoming very high in your portfolio. And you have actually put in a lot of money into it. Where a stock performs stupendously, you haven't put money to the extent of 50% of your portfolio. You may have put some 8-10% and that could have done extremely well. But this situation is very different where you have put 50% of your portfolio money in one stock. Now this situation should be something that keeps you very cautious. The reason being that your own capital, your savings has gone into one stock to an extent where that amount itself can become a risk. In that situation, it's very important that you gradually mitigate that risk, reduce it and make your portfolio stable and balanced. Even in the situation where a stock has turned out to be a big winner and thereby become too big in your portfolio, you still need to manage your risk and give portfolio much needed stability. Because if something goes wrong in that company, then your whole portfolio will come down. And that is a risk which you cannot afford to take. Most people associate selling with exiting. I am not telling you that you should exit the entire stock position. To exit a stock position, you must be sure that its potential has fully played out and going forward, it will probably have a very long time or price correction. In that situation, you can exit. But if you feel that this company is going through a very long patch of success and that is going to last for much longer and the valuations are still not reached a level which is alarming to you, then an exit may not be warranted. You only need to do risk management and you need to mitigate the risk of a single stock in your portfolio. Now, how do you do this? You can sell gradually and you can put that money in stocks which are just as good as what you sold or better. Never invest money from a successful investment into a stock which you know is a lesser company or qualitatively not so great. So if you have success in a company and you make a lot of money, when you take that money out and reinvest it, make sure that you reinvest that money in a better company, in a superior opportunity. Otherwise, wait. But selling should not necessarily wait for you to get a buying idea. You can sell and keep the money idle. Don't worry about your money idling for some time, because the opportunity to de-risk may not be available for too long. So, when it is before you, use that opportunity. By doing this constantly, you are able to sell stocks in companies which become too big in your portfolio, and you are able to keep that money aside to invest in stocks of the same standard or even a better pedigree going forward. And as you wait, you look for a stock which is just as good, if not better. If the same stock goes up further and once again becomes too big in your portfolio, then you again think of reducing your exposure and releasing more money to be reinvested later in better opportunities. Now, this process should constantly play out in your portfolio. So, you continue to hold your winners, but you ensure that your winners don't become a risk to the stability of the portfolio. So, you gradually pair them. Then, while you wait to buy the next big winner, give yourself enough time to be convinced that what you are reinvesting in is just as good, if not better, than what you sold. By doing these things, you can mitigate single stock risk gradually and in a disciplined manner, and you will also ensure that you find better stocks to replace a successful investment which you are selling. So, this in effect is how I think you should deal with single stock risk. And whenever one stock becomes too big in your portfolio, make sure that your risks are lowered and you are also preparing for better opportunities in the days ahead. The market is always generous to those who have the patience and temperament to wait for the right opportunity. So, if you are able to do that, you will be a big winner and you will also capture your winnings in your portfolio. Thank you for watching this video.